Let's bring in the top, Wall Street's #1 audacious market leader, Yardeni Research President Ed Yardeni. Ed, I got to tell you, one thing I've always loved about you is you're a straight shooter and you're optimistic. And so you're looking at 2026, another year of living audaciously. Let's talk about that.
Well, you know, I've been talking about the roaring 2020s since 2020. 2020, that looked like a delusional kind of scenario, but it's worked out very well so far through 2025. I'm really just arguing that it'll be kind of more of the same in 2026, that the market's going to go higher, not as big a percentage increase, maybe a 10% increase to 7,700, but that's pretty good.
That is pretty good. Before we get to like the audacious drivers in 2026, what was it about 2020 though, right? Because I wrote a book published in 21, and I also had a big talk. I talked a lot about a redo of the 1920s.
Right.
I saw a lot of parallels coming out of a war, of course, the war on terror, the Spanish-American War, the Spanish flu, all these things, and we had a big recession.
A lot of negative similarities.
Exactly, but positive too, because we ended up with a president and then another president back to back who were pro-business. I mean, but you saw all of that coming.
Well, what I really saw coming, most importantly, was I perceived that as the baby boomers started to retire, that the growth rate of the labor force would slow down. I didn't really factor in what was going on with migration and deportations and all that. To me, the key variable that I had some handle on was the demography of the baby boomers. And as they retired, I figured that we would be finding a shortage of skilled workers, and that companies would be under a lot of pressure to figure out how to increase productivity, and that just by coincidence there'd be the technology tools to do that.
Right.
I kind of mentioned AI, but I didn't expect that it would be start to become a big deal at the end of 2022.
I think that on October, November, ChatGPT, an innocuous announcement, right? Sort of like, hey, we got a new version of this thing, and it sort of woke everything up.
Right.
I want to go to this baby boomer thing since you brought that up, because there's one thing about the baby boomers retiring and that part of the equation, but it feels like the other part has been living their best lives, right? They're spending a lot of money, they're making a lot of money, their assets are worth a lot. You know, it's kind of, there's an imbalance there that we see political ramifications, but from a market point of view, it's been phenomenal. Yeah,
well, you know, some people have called it the K economy. I'm kind of still scrambling around to figure out an alternative, but I think it's more demographically.
This is the one I used. I used the French E. Is that the one, like whatever, the one with the little thing here? I say that's everyone with all the cash in the rest of the country, but that's
I don't know how to tell you that, but that looks like Chick-fil-A.
Well, the Chick-fil-A economy. But I mean, the baby boomers, they're living longer. They have all they own stock, they own real estate, and they're spending money.
And they're helping their kids.
Right.
I see that with all my friends. I mean, clearly the baby boomers have done extremely well, and it's what Spock told us, not Dr. Spock, who I guess influenced our mothers, but Spock from Star Trek, live long and prosper.
Yeah.
We've lived long, and we bought houses, we bought stocks, we bought insurance policies, and you know, compounding of wealth has been phenomenal. But I think there's a tremendous amount of helping the younger generation. So I think it's not so much that it's haves and have-nots, so much as a demographic phenomenon. I mean, when I first started working, I was making $20,000 at the New York Fed. It happened to rent that back then was $400 a month. Right. But the cost of living.
Well, that's another thing that you see next year. President Trump addressing the affordability issue. We keep hearing rumblings about helping the housing part of this and other parts as well.
I think a big part definitely is housing. I mean, home prices have gone up a great deal, and you know, the baby boomers have paid off their mortgages, and they've seen their home prices continue to go up. But meanwhile, their kids can't afford to buy a house, and the baby boomers aren't moving out of their homes.
So in your most recent report, you talk about both AI story and contrarian indicators are mixed. You know, one thing I thought about this year was not contrarian, but let's call it contradictory. Yeah. It feels like a contradictory stock market in some ways and economy. So we had this GDP number, 4.3%, absolutely phenomenal. You got consumer spending, exports, imports. You got all this stuff here, but you go down to line 34, disposable personal income, 0.0%. Right. I mean, are we living in a world? Can we live in a world where there's sort of jobless, wageless prosperity?
Short answer is no. I think we need consumers. Obviously, the U.S. economy is very much driven by the consumer. But I think instead of the head count of consumers going up a lot, as it did when the baby boomers first entered the labor market, I think we're going to see a much slower pace of head count So that means real wages have to go up, and that's usually in the past what real wages have always done. They've always gone up with productivity, so that it all ties together. One more thing, and that is, again, the demography is a key issue here.
Right.
The younger folks aren't making that much, and the baby boomers are retiring with a lot of disposable income.
Let's talk about the market itself, because so you're looking for 7,700, I think 360 on earnings, and you have a PE ratio of 22.
Yeah.
But I think you're thinking, though, that it's going to shift, though. In other words, right now, if you look at the growth industries, consumer discretionary, they're at 89, 72, big time highs in terms of the relationship with absolute PE. If you look on a relative basis, then you see, looks like a lot of opportunity outside of a mag segment in tech.
I think so. I think so. If you take information technology and communication services, you find that they account for 45% of the market cap of the S&P 500. I've been telling people to overweight those two, but I can't do that anymore. They're too large.
Right.
And I do think that the beneficiaries of AI and other technologies, namely the impressive 493, are the ones that are going to benefit the most.
Wait a minute. Did you trademark that yet?
No.
The impressive 493. Okay, I like that. We're going to give you some props on that one, okay? But you're saying, listen, what's going to be earnings? What's going to bring them into the, okay.
Yeah, I mean, the impressive 493s are the ones that are going to get the big productivity boosts from all these technologies. And by the way, just about every company's looked at AI, and some of them may conclude, hey, you know what, it's really not that relevant. However, we found a lot of things that we could do more efficiently aside from AI.
Let's talk about gold, because all the gold bugs are singing your praises once again. You've raised your target now, I think, for 2027. Yeah. What is it now? It's 8,000.
Let's focus on 2026.
Okay.
Let's do one year at a time. And I was looking for 5,000. I was looking for 4,000 this year, and we shot above it. And I thought we were just going to kind of go sideways for a while. And then we shot up to like 4,500. Right. And now we're shooting down by a couple of $100 today. I think it may very well continue to meander till the middle of the year, and then I think you'll see.
But 6,000 is reasonable.
Yeah, I raised it from 5,000 to 6,000 in 2026.
And you're still looking at by 2029, 2030, 10,000.
Yeah, by the end of the decade, 10,000. Same as the S&P 500, 10,000.
What about bonds? What kind of bond allocation do you have?
It obviously depends on the investor. But I think bonds will earn you the coupon, and I think the range is going to be about 4.25 to 4.75 for the bond in 2026
What's the greatest risk that you see then going into next year for next year?
Well, historically, for the stock market and the economy, the biggest risk has always been something blowing up in the credit market. And so I am looking at private credit, but I'm not that worried about it because these are diversified.
These are some high-profile stories, but not,
but they're diversified portfolios, so you get maybe a lower return on some portfolios. I think the biggest risk is the bond vigilantes don't like all this stimulus. The monetary stimulus may be about to really hit. They're doing QE again. And then on the fiscal side, the president and the secretary of the Treasury have both said that we're going to have humongous refunds in the tax season because the big, beautiful bill was retroactive to the beginning of this year.
Well, we know that the Trump Fed is going to run it hot. We'll see where that takes us. Ed, great stuff.